I think that one of the issues that's underappreciated by investors in today's market is the idea that return is a function of risk. Now, you have to put this in context. We've come off a market bottom 5+ years ago. The market's up over 200%. And so, in the context of where we've been, it's more likely as we go forward, returns will be lower on an annualized basis than the 200% we've seen over the last 5 years, okay? PEs have normalized, earnings growth rates have normalized. You will get more normal returns as we go forward. And as we do that, the idea is how much risk are you taking for the return you're generating? I'll give you an example. If you have 2 strategies and those strategies are returning 10% and one is taking excess risk, use beta as a measure of risk. It's got a 1.3 beta and it's generating a 10% return, and another strategy is generating a 10% return with a 1.0 beta, so market type risk. Obviously, you want the lower risk strategy with the equal return. So the idea of risk-adjusted returns, I think, is a concept that gets lost in a more mature bull market. How much risk am I taking to generate that return? The other thing that's important that goes in conjunction with that is I would generally evaluate other managers on how they do during tough times, not how they do during great times. Okay? And if you look at how your managers do or how those strategies do during bad times, that tells you a lot about what your expectations should be going forward. I guess it's a refresher or a reminder that markets don't always go straight up, and that we will have probably more volatility as we go forward. And as we have that, but positive, I'm expecting the markets to continue to be good, but more normal. Okay, as we have that normal volatility, what should you expect from your strategy in terms of not only the upside participation, but the downside protection as you go forward, and how much risk is being taken to generate those returns?